Hey everyone, this is the Trader Investor. In today's video, I want to talk about risk management. I think it's a very important aspect that I mention all the time, but I didn't give you how I look at risk and how I position myself. And the focus for today is going to be stocks and options. And then I'll do other videos for Forex, for crypto, because the way you calculate these risks is a little bit different. So let's just focus on stocks and options on stocks for now. So that would be our focus, and how I look at risk management and how much do I risk per trade. It's all tied in to account size. So that's a critical thing to keep in mind, and that's what we're going to do today. I know I've said there's a lot of learning I wanted to do this weekend with Mother's Day. Today I did not have a chance to do an extensive study outside of risk management, and I want to apologize for that. I will make it up to you, because I will do one extensive study over the coming week and not wait until the weekend for that. So let's just dive right into risk management. What is risk management, and how do we look at it? So the definition for me of risk management is based on my capital. How much risk am I willing to take for my trades? So for every position that I take, I must know my risk before I enter the trade. If I don't know the risk, I am not entering the trade. This is critical. And you'll see why it's critical in a couple of minutes. But it's one of the most important things you can do in your trading. I talk about save a lot. Save meaning structure, area of value, execute. And execute involves risk management. And save is my anchor for all my trades. But in save, number 3E, execute includes, for all my entries and exits, risk management. Risk management means if my trade goes my way, there's no risk to that trade. Fantastic. If my trade goes against me, how much of a risk am I willing to take? That's a very, very important piece. And that is going to be dependent on how much capital I have at play. And the risk has to be always calculated as a percentage of my capital. Dollar amounts can get confusing, but if we stick to percentage, then your account size doesn't matter. As your account grows, you can stick to this percentage. You can shift the scale a little bit on your percentage based on your tolerance and what is acceptable to you. But we're going to stay in the general, guideline that I will be sharing with you over the next few minutes today. And also, you see the word here, worst case scenario. What does that mean? What that means to me is when I enter a position, if I am taking that position, especially overnight over the weekend, and that position completely goes to zero, that's the worst case scenario. How do I look at that as I enter my positions as well? And that's also another critical piece that we have to look into. So let's start with percentage of capital. If you take a position and that position wipes out 50% of your capital, then the remaining 50% has to grow by 100% to break even. So you're in a very, very big hole if you have taken your account to a 50% loss, especially if it happens in one or two trades, right? If you're taking big risk all the time, 25% loss or 50% loss per trade, then that's dangerous. What does that mean? Like, let's say you take positions that are not appropriate to your account size. And if a dollar move might even make your account lose 50% of its value because of your position sizing. If you over leverage, because that's what options allow you to do, is leverage. If you over leverage, it becomes dangerous. Let me just address real quick by what I mean by over leverage. If you have a $50 stock and you have a $5,000 account, you can buy 100 shares, right? So instead of buying 100 shares, you can also buy a smaller amount of shares. But let's just say you're going to stick with buying 100 shares using all your capital. But with options, if the options that you choose, let's say this week's expiration costs $2, let's just say hypothetically $2, that means that contract is now worth $200. So the same 100 shares you can control with $5,000 stocks or $200 options. But where people make the mistake and over leverage is, oh, it's only 200, let me do 5 contracts, let me do 1,000, right? 1,000 shares, let me control 1,000 shares and do 10 contracts, let me control 500 shares and do 5 contracts. That's where you get into the danger zone, because if your option goes against you, if the price does not move in your favor and that option goes to zero, you now have lost. If you have done 5 contracts, you have lost $1,000. If you have done 10 contracts, you have lost $2,000. If you had bought the stocks, you would have only been able to do 100 because your account size only allows for 100. And if stock price moves $2 or $3 against you, you're only removing $200 or $300, right? Even if it moves $10 against you, you are removing $1,000 at the maximum. But with options, all it has to do is stay below your strike price by a penny, and that option goes to zero. Therefore, you become over leveraged and you lose your account very quickly because of that. So very, very important, do not over leverage your account. And as I go into how I calculate my risks, it makes it easy for you to understand how to position yourself. The reason why I want to talk about all of this is, again, like I said, if you lose 50% of your account, it takes 100% gain on the balance to break even. And then you're exhausted, you're wiped out, you're going to tap out and ignore everything else and go away from trading because it is too much work. Let's avoid that. If you lose 25% of your capital, it requires 33% gain on the balance to break even. Much, much, much better now, right? It's much, much better. Now, we're going to do even better than that, because I don't want you to risk 25%. I don't even want you to risk 5%. What we're going to risk is much less. If you risk 10% and you lose 10% of your account, you only need 11% on the balance to break even. You see how as our risk decreases, our recovery also decreases significantly, making it easier, and we don't give up, we're not exhausted, we're not stressed in each trade. If you even take your risk level to 3%, 2%, 1%, and every time you lose 3%, you only need to add about 3%, slightly over 3% to break even. Same thing with 2%, same thing with 1%. That's why in my trading, I like 1%. There are some people who say, well, my account does not grow fast enough with 1%. That's a matter of judgment. But it is important to understand, for me, I like to risk 1% per trade. And at that 1%, I am satisfied with the gains. And I risk 1 to make 2 at least. Sometimes I make 3, 4, 5, 10, but I'm only risking 1%. And worst case scenario, my number of contracts, my position says if the whole thing goes to zero overnight, then I only want to risk maybe 3%. Right? I want the total value of those options not to be more than 3% of my account size. That's a critical way of thinking about how I enter positions. So when I enter a position, the E part of save, the execute, entry, and exit. So my exit on the worst case scenario is my risk. And so the way I calculate my risk, as I said, is 1% of my total position. But then what I want to do is, what does that mean in terms of my position size percentage itself? So for example, $5,000 account, I want to risk 1%, that's $50. So if I take a position and I enter a $200 position and I'm risking $50, I'm risking 1/5 or 1/4. I'm risking 25% of that position size, not the account size. Let me repeat that. Let me make it clearer. 1% of account size does not mean 1% of position size. So let's write this out. Let me try to draw this out. You have, I am not good at this free flow, but you'll get the idea. I'm left-handed, so that it makes it hard for me to draw with my right hand, and I use the mouse on my right hand. But let's just please bear with me for a moment. If I am risking 1% of my account size, I'm only risking $50. I'm only risking $50. If one position is $200, then this $50 is 25% of that position, because $50 is 1/4 of 200. So let's not get the two confused, because where many people will panic is, this is 25%, but so what? It's only 1% of your account size. So be willing to take this risk. This is where we have a lot of room to play with. Maybe we don't take a $200 position. Maybe we take a $100 position and have a 50% stop loss for that position. That's okay. It's absolutely okay, because we are still staying here. For us, this is the key part. This is the key part, because this is tied to account size. This is tied to position size. I hope I'm making it clear. Your account size, 1%, 2%, 3%, whichever tolerance level you want to use. And then you break it down to the position size and say, what does that mean for this position size? A lot of times, for me, I ignore this number. I don't look at this number. I don't care what this number is. All I do is I enter a position. What is the maximum I'm willing to lose? 1% of the account size, $50 in this case. So I'm saying I enter a position of 200, $50 is all I'm willing to lose. End of the story. No need to worry about the percentage, but I gave you the percentage in case you want to calculate and want to look at it from that perspective. So if you do that, let's look at examples, how I would enter a position. And let's start with stock. If a stock has a value of $50, how many stocks can I buy for a $1 stop loss? I can buy 50 shares, because if I lose $1, that times 50 shares, that's $50. So that's all I would buy. I'll buy 50 shares, $5,000 account, that's okay. I can spend half of that, $2,500, because I'm only risking 1%. Where I will slightly deviate is instead of buying 50 shares, I might buy 45 shares, 44, 46, 47 shares to allow for some slippage. If I have a dollar stop, but it goes overnight, it goes against me $5, for example, I will never know how much of slippage I need to put in, but I want to give myself a little bit of a buffer room so that I don't go crazy on my stop loss. So 50 shares, if it drops by $10, I'm losing $500. So that's the risk we have all the time. That's a very known risk that we have. So we have to kind of be willing to manipulate those risks to our tolerance level, right? So that's the key part. But if we look at this previous slide where I put worst case scenario, right? I want to sometimes include worst case scenario, but very difficult to do that. And one of the ways I avoid worst case scenario is when I'm considering a position, is there a catalyst that could move the price up or down? What do I mean by a catalyst? Is there an earnings report? Is there an FDA approval? Is there a court judgment that's about to be decided? Is there some catalyst that could drive this market one way or another? If that's the case, I will most likely skip the position completely because I don't know what my risk is. I don't want to wake up at a $50 stock. I don't want to wake up with a $10 loss. That's a big drop, right? So if I'm buying 50 shares, that's $500. That's 10 times more than what I want to lose. That's 10% of my account size that is going to go overnight. And so if there's a catalyst, I skip the trade. Let's take this example and see how many contracts we can enter using options as an example. So if I am doing 1% stop loss, then if one contract costs $1.25, meaning $125 per contract, then at 1% loss, I can enter 4 contracts because 1% meaning about $25 that I want to lose, 2 contracts. Sorry, not 4, 2 contracts. Because if I'm willing to lose $25, like I said, it's not 1% of my position, it's 1% of my account size. So if I'm willing to lose $25 per contract, then I can only enter 2 contracts. Because that's 125 minus 25 times 2, that's $50. If I'm willing to do 2%, I can do 4 contracts. If I'm willing to do 3%, I can do 6 contracts. So that percentage is key then, right? This number is the most important number to know. And do I want 1, 2, or 3? I said for me my preference is 1. And I only want to look at 1%. So if you look at that as an example, only 1%, if you have a $5,000 account, that's $50 that you can lose. If you have a $10,000 account, that's $100 you can lose and still be within your 1%. Allow a little bit of slippage, that's okay, that's part of the business. So all in all, the key part of today's video is risk management. Know your capital, know your risk, and calculate every entry based on your total risk. And here's the next step. Every time your account changes, every time. So you take trade 1, win or lose, your account has changed. Now it's that 1% is calculated on the new value. So if you lose $50, then from 5,000, then the next time you calculate is $45 that you risk, because it's $4,550 is your account size, because it has gone down by 50. If it goes up by 50 or by 100, because you're risking 1 to make 2, it goes up by 100. Now you can risk $51 because your account size is 5,100. So every trade, your account size changes, and you adjust your entry based on that. How many positions can you enter simultaneously? And by that, I don't mean number of shares or number of contracts, but separate positions. This is where it requires a little bit more research and study. If the positions you are entering are correlated, meaning if one moves up, the other moves up, if one moves down, the other moves down, then you don't want to enter two positions, because what you're doing then inadvertently is doubling your risk, because they're going to both move in the same direction. So another critical part to consider. If they're not correlated, then you can enter 2-3 positions, because your total risk is limited to 1% per position that you take. If they're correlated but one doesn't move with the other normally, then I could venture and say at least enter half position in each, or maybe 3/4 position in each, and do a position and a half instead of doing 2 positions. Because they're correlated, there's a chance that they will move together. So have all of this in consideration. And the red box here, the most important, is percent of account. 1% of 5,000 is $50. 3% is $150. Which one are you comfortable with? And 2% in between. Which one are you comfortable with? You have to go with that level. And remember, if you lose 50% of your account, it takes you 100% gain of the balance to get back to break even to your original account size. So that is why I want to stress risk management, risk percentage. Until you become extremely good, just stay with one. Because those $50, they add up. You think $50 is not a lot of money. I want to risk 20-25% because I want to grow my account fast. That's again going into the greedy territory. So, risk some amount, calculate your risk, calculate how much you're willing to lose, and be okay with that, and risk that amount, and slowly add up. And as you increase your comfort level, as you increase your expertise, then you can go from 1% to 3%. Never more than 3%. That I will never recommend more than 3%. Only 1, 2, or 3, at the max 3. But even I myself have been doing this for many years. 1 is good enough for me. A lot of times I don't even risk 1. And I will do SPY contracts. There are sometimes for my account size, I can do quite a bit, but there are sometimes where I only do 5 contracts, 10 contracts. And I could do more, but there are different circumstances I look at. What is the overall market telling me in terms of fear, sentiment, greed in the market? If there's fear, do I really want to enter full position in the bullish direction? If there's greed, do I want to enter full position in the bearish direction? All of this has to be put into the picture as you put the percentage of the calculation. So 1%, you will grow your account fast. You just have to be patient, and you have to be consistent at making those 1%. So risk 1 to make 2, risk 1 to make 2. So slowly your account will grow. So that's what you need to do. So don't worry about that 1% being just a small 1%, because the gain will only be 2 or 3%. Don't worry about that. It is critical to preserve your capital. Rule number 1 is don't lose money. Rule number 2 is don't forget rule number 1. This is something that I heard that Buffett uses all the time, and I really subscribe to that, because I used to have rule number 1, risk everything. Rule number 2, don't forget to risk everything. That was how I used to trade. But now I'm subscribing to Buffett. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. And the only way you do that is you minimize your risk, you maximize your gain. This is what I wanted to spend time today on risk management. And I have a spreadsheet that I use that makes it easy for me to calculate how much of a risk I should take per position. If you're interested in my spreadsheet, drop me a note in the comment section and I will share my spreadsheet with you. All right, everyone, don't forget to like this video. I'm pretty sure it's going to help you out a lot and change the way you look at trading, change the way you look at taking risks, and then improve on your gains as you move forward. All right, everyone, take care, and I'll see you in the next one.